You Can Be a Stock Market Genius is Joel Greenblatt's classic 1997 book. Don't be dissuaded by the ridiculous title. This is a money-making handbook for the small investor who's willing to get their hands dirty and do their homework. Joel Greenblatt is one of the best investors of all time. You Can Be a Stock Market Genius discusses the strategy that Greenblatt employed when he was running his hedge fund from 1985 to 1994 and achieved 50% annual returns. The goal of investing is to find mispriced assets. You want to seek out areas of the market where stocks are prone to mispricing. Let's start exploring some of the secrets to investing in special situations. 1. Spinoffs. One area that Joel Greenblatt finds to be replete with mispricing is spinoffs. Spinoffs are divisions or subsidiaries of a larger company. The larger company decides to spin off that piece into a separate company. Why do companies do this? They may think that if they isolate the entity in the market, it'll be able to command a higher valuation. For instance, let's say, in an extreme example, that an insurance company owned by a financial software division, software companies have higher PE ratios than insurance companies. However, the market might not appreciate the software company because it's buried in an insurance company. If they spun it off, the software company would probably command a higher valuation if it were isolated. The larger firm might also want to separate itself from a bad business that's weighing it down. They might just want to use the spin-off to unload debt on a smaller firm. There could be tax or regulatory reasons. They might have difficulty selling the business, so they decide to dump it in the form of a spin-off. Whatever the reason, spin-offs are prone to mispricing. This is because institutions and people often sell them for reasons other than the intrinsic value of the company. Some institutions might not even be allowed to own it due to small market capitalization, or it doesn't fit into their strategy. Individual investors probably wanted to hold the larger business and have no interest in owning something completely different. In any case, spin-offs are prone to indiscriminate selling, which creates mispricing and opportunities for smaller investors like us. 2. Mergers. Merger arbitrage is buying a stock after a deal is announced and trying to earn a spread between the buyout price and the market price. For example, let's say a company is trading at $30 and another company buys it out for $40. As soon as the deal is announced, the stock will rally to $39. A merger arbitrage strategy would buy the stock at $39 and wait for the deal to be consummated. However, Joel Greenblatt says that merger arbitrage is best left alone by most people. It's not a surprise that the majority of fraud that was committed in the 80s by Ivan Boesky and guys was in this area. It's very hard to trade in this area with public knowledge, and people with insider knowledge can almost always trump them and can easily manipulate the public side investors by leaking news, if they wanted to, while wishing away jail time and fines. For public side investors, this is not a good deal from a risk-reward perspective, and one has to monitor news at all times to see which way the winds are blowing. Where he does believe there are opportunities for investors is in the world of merger securities. Joel Greenblatt says that the one place that one would like to be involved in the merger arb business is the area of merger securities, used when the acquirer has exhausted all the other ways of paying for the acquisition. As a general rule, no one wants merger securities, and they're often sold right away. And this indiscriminate selling creates a great buying opportunity. 3. Bankruptcies and restructurings. Emotions create mispricing. Greed and comfort with consensus create insane valuations for amazing companies. Joel Greenblatt does not recommend buying stock in bankrupt companies. That's in the too hard pile. The reason is apparent. Equity holders can get wiped out in a bankruptcy. He does believe that the debt of bankrupt companies is often mispriced and offers incredible mispricing. Unfortunately, distressed debt investing is not only challenging to research for small investors, but frequently impossible for anyone but an institution to invest in. However, he believes that small investors can invest in companies emerging from bankruptcy or going through a restructuring. Often a company went bankrupt only because it was loaded up with too much debt. They might have a viable business model that was merely being weighed down by too much debt. After emerging from bankruptcy or going through a healthy restructure, it may give the company an opportunity to shine. Meanwhile, the stigma of the bankruptcy creates a nice discount between the company's stock price and its intrinsic value. 4. Recapitalizations, leaps, and options. Joel Greenblatt takes a bit more of a liberal attitude towards options. While he doesn't recommend actively trading options, he does suggest using long-term options, leaps, options contracts that mature in over a year, as a way to leverage up the return on a value stock. A leap will experience more significant price swings than the overall stock. If a reasonably priced value stock experiences a 20% gain, for instance, the underlying leaps contract will experience a much more significant increase. It's a way of leveraging up the bet, with the caveat that if the stock falls below the strike price, it'll expire worthless. More risk, more reward. Greenblatt does not recommend that these bets comprise a significant portion of a portfolio, but argues that they can serve as a place to amplify returns. And that's all we have for this episode. If you've enjoyed this, please give this video a thumbs up and subscribe to my channel. Thank you all. I'll see you soon, and have an excellent rest of your day.